Hey everybody, Ed Matthews here at Clark Street Capital. This week's edition of Ask Ed is all about accredited investors. So this week, Dave from Guilford, Connecticut asks, what is an accredited investor and how do I become one? That's a great question. So basically, the Securities and Exchange Commission provides special status for people and entities under certain circumstances to be allowed to participate in non-registered investments like multifamily syndications, for instance, because the SEC considers them to be a little more experienced and have the means to participate in somewhat riskier investments and be able to bear any potential losses. So to be considered an accredited investor by the Securities and Exchange Commission, it's actually pretty straightforward. You have to have an income of $200,000 a year for the last 2 years as an individual, with the expectation that it would continue for the next coming year, or jointly $300,000 a year for the last 2 years, with the expectation that that also would continue this coming year. Or you can have a net worth of $1 million, or as an entity, you have to have assets in excess of $5 million. So that said, the SEC has also provided a series of amendments published back in August of 2020, where basically it allowed a handful of exceptions. One exception is the individuals with professional certifications or designations or credentials that are issued from an accredited institution. The SEC may accept those from time to time. Second are individuals who are considered knowledgeable employees, and typically they work for private equity funds. You can also be an entity such as an Indian tribe or a government body or a fund or an entity organized under the laws of a foreign nation, but you do have to have those $5 million in assets. You could be a family office. Again, you must have $5 million in assets under management. And then the last exception is what's known as the spousal equivalent, which means a married couple can pool their resources to meet the requirements of the SEC regulations. So now you're probably asking, why does the SEC even have these kind of regulations? And the fact is that they're there for your protection. Basically, they're looking to make sure that syndicates and private equity firms like Clark Street Capital are working with individuals and entities who have the financial experience and background to be able to effectively evaluate what can be potentially riskier types of opportunities. And so they want to make sure that the individuals and entities understand the upside and downside of each of these projects. They also want to make sure that these individuals and or entities have the financial resources to weather the downside in case something bad happens. And so that's why these regulations have been put in place. So that's this week's edition of Ask Ed. If you liked what you heard today, or if you found it useful, please feel free to share it, like it, or comment down below. I read every single comment. If we can be of service, please give us a call at 860-675-5800. Shoot us an email at asked@clarkst.com, or visit us on the web at www.clarkst.com. Until next week.